Why do prices almost never go back to where they were? You hear that inflation is coming down, and then you look at rent, groceries, car insurance, and it still feels like you're paying the new higher menu. Most people assume that means someone failed, or someone got greedy, or the crisis just hasn't ended yet. The twist is that in modern economies, inflation isn't treated like a random fire to put out once and for all. It's closer to a slow leak that important parts of the system quietly learn to live with, because patching it completely would break other things. First, a quick reset on language, because this is where the confusion starts. Inflation is the rate of change, not the level of prices. If inflation falls from high to low, prices usually keep rising, just more slowly, and that's called disinflation. For prices to actually come down across the board, you need deflation, and that's rare, because prices and wages don't like moving downward at scale. So when the news says inflation is improving, it often means your costs are still climbing, just not as fast. That gap between the headline and your receipt is what makes people feel gaslit. Now the thesis, stated plainly. Mild currency debasement is structurally favored. Debt-heavy governments, asset-dependent markets, and big pension and entitlement systems all run more smoothly when the value of money shrinks a little each year. That doesn't mean inflation is always intentional, and it doesn't mean every spike is planned, because supply shocks are real. It means that when policymakers face hard choices, the incentives often point toward tolerating some inflation rather than forcing the system through the pain needed to stamp it out completely. The roadmap is simple. Debt, then the toolkit, then markets and pensions, then who pays. Start with debt, because debt is the easiest place to see the incentive. Imagine you owe a fixed-rate mortgage payment that doesn't change, while your paycheck and the general price level drift upward over time. In real terms, that payment shrinks. The debt is like an ice cube that slowly melts as the room gets warmer. The same logic applies to government debt, which is mostly stated in nominal dollars. If a government can't raise taxes easily and voters won't accept spending cuts, letting inflation run a bit becomes the quiet third option.
The catch is that fighting inflation with higher interest rates raises the government's interest bill.
You can see a version of this after big debt buildups, like the period after World War II. Countries didn't all pay it off the way a household pays off a credit card. They grew, they ran moderate inflation, and they kept borrowing costs from running away. That's not a moral story, it's a mechanical one. When you owe a lot, you care less about the purity of the currency and more about keeping the financing machine stable. And when rates rise, it can feel like chemotherapy, sometimes necessary but painful enough that you only push it so far before the side effects become politically unbearable. So how does the system manage inflation without openly saying, we like inflation? One answer is the inflation target itself. Many central banks explicitly aim for around 2% inflation, not zero, and they defend it with arguments like avoiding deflation spirals and dealing with wages that resist cuts. Those are real concerns, but there's also a practical benefit. A small, steady erosion is easier to live with than explicit tax hikes or visible benefit cuts. Central banks mainly pull levers like short-term interest rates, messaging about future policy, and balance sheet tools like buying bonds in large quantities. These tools don't control every price, but they shape the financial conditions that decide how easy it is to borrow, spend, and bid up assets. This is where financial repression comes in, and it sounds dramatic, but the plain English version is simple. If the system keeps the safe, boring return on cash and government bonds below the inflation rate, savers get a negative real return and debtors get relief. It can happen through low policy rates, large central bank bond holdings that compress yields, and regulations that nudge banks and institutions to hold government debt as a preferred asset. No smoke-filled room is required. The incentives do most of the work. If the choice is between paying higher interest to bondholders or letting the currency do some of the adjustment, the currency often gets the job. But this only works while credibility holds, because if people expect higher inflation, lenders demand higher rates, and the trick stops being cheap. Now zoom out to markets, because markets are where the fear of deflation shows up most clearly. When interest rates are low and liquidity is abundant, the price of long-lived assets tends to rise because future cash flows get discounted less and borrowing feels easier. That's one reason you can get an everything bubble feeling, where stocks, housing, and even private assets all levitate together. Policymakers react aggressively to sharp crashes because asset prices aren't just numbers on a screen. They're collateral in the banking system and confidence for consumers. If housing falls hard, refinancing dries up, construction slows, layoffs rise, and suddenly the inflation problem turns into a jobs problem. So the system becomes biased toward preventing asset deflation, even if that means tolerating more inflation than people say they want. Pensions and entitlements add another layer, because they are promises written in nominal terms. Many retirement systems assume some combination of nominal wage growth, market returns, and steady contributions. But aging populations and slower growth make that math tighter. Inflation plus asset appreciation helps, because it lifts nominal revenues, nominal earnings, and nominal portfolio values, which makes it easier to meet nominal promises. Retirees aren't immune though, because inflation hits their grocery bill and rent immediately. Cost of living adjustments exist in some systems, but they can lag, they can be capped, and they don't always match what older households actually buy. So inflation is a mixed blessing, even for the groups it supposedly helps. If you want a recent mini example, think about 2020 through 2022. You had supply chains that broke, energy prices that jumped, and a lot of fiscal and monetary support landing in the economy at the same time. Inflation surged, and then policy tightened, and inflation rates cooled from the peak. But most prices didn't rewind, they reset to a higher level, and households had to rebuild their budgets around that new baseline. That's why the inflation is down headline can coexist with the feeling that your lifestyle got more expensive permanently. The system can squeeze inflation down, but it rarely chooses the path that forces broad price declines, because that path tends to come with defaults and unemployment. So, who pays for this arrangement? Inflation pressures people who live on wages that adjust slowly, and people who keep a lot of savings in cash. If your pay rises once a year but prices rise all year, you're financing the gap. Renters often feel it faster than homeowners with fixed-rate mortgages, because housing costs reprice quickly in the rental market, while a fixed payment stays fixed. Borrowers with fixed rates can benefit, while savers in low-yield accounts can lose purchasing power quietly. Calling inflation a tax is partly true, but incomplete. It's also a transfer from holders of nominal claims to holders of real assets and to debtors. The unfairness isn't evenly spread, and that's why the experience of inflation depends so much on what you own and what you owe. There is a real constraint though. Inflation can't be unlimited. If it gets too high, people notice, trust erodes, wage demands jump, lenders demand higher yields, and the government's financing costs rise anyway. That's why the system tends to aim for controlled inflation rather than runaway inflation, and why the 2% target became a convenient focal point. It's high enough to grease the gears and low enough to defend in public, and it's easier to sell as price stability than to admit that the system likes a predictable haircut on the currency. In practice, the target is as much about politics and debt management as it is about textbook ideals. Looking forward, the tailwinds for persistent, manageable inflation are easy to name without guessing exact numbers. Supply chains are less optimized than they were. Countries are reshoring some production. The energy transition requires heavy investment. Demographics reduce labor supply in many places, and defense spending pressures budgets. None of that guarantees constant inflation, but it makes inflation easier to rekindle after each shock. Here's the one-sentence takeaway to keep in your head. In a high-debt, asset-dependent economy, mild inflation is the path of least political resistance, until it stops being mild. If you want signals to watch, pay attention to real interest rates, debt to GDP, and fiscal deficits, how tolerant central banks sound when inflation runs hot, wage growth versus consumer prices, and whether long-term bond yields start climbing on their own. When those move together, you learn more than you will from any single monthly CPI print. And for personal resilience, think in principles, not predictions. And this isn't financial advice. Build an emergency buffer so a price spike doesn't force bad debt, and understand which of your obligations are fixed versus variable, so inflation and rate hikes hit you differently. Focus on skill and bargaining power, because wages are your main inflation hedge if you don't own many assets. Diversify across what you can reasonably access, and be honest about concentration in one asset, like a single house or one company's stock. Most of all, stop waiting for prices to go back, and start watching the incentives that make persistent inflation the default setting. If you want, leave a comment with the one price that changed your behavior the most, and tell me what you think policymakers are really optimizing for. And if this was useful, subscribe for more systems-level explanations without the outrage cycle.